Coming to terms with a pandemic that just won't quit and with a Russian threat to Ukraine. This is Bloomberg Wall Street Week. I'm David Westin. This week, a roundtable with contributors Larry Summers of Harvard and Steve Rattner of Willett Advisors.
We've put in motion for the first time in 40 years excessive inflation caused by overheating of the economy.
Afsaneh Beschloss of Rock Creek on investing in the face of so much uncertainty, and Bank of America's Brian Moynihan on what he sees ahead in 2022.
We're at 4.2% for next year and 2.2% for the year after. That's a slowdown from this year, but the reality is it sort of has to slow down.
The week began with President Biden confronting Russian President Putin over Russia's military buildup along Ukraine's borders, with National Security Advisor Jake Sullivan reporting that the U.S. made it clear that it would take action in response to any invasion.
He told President Putin directly that if Russia further invades Ukraine, the United States and our European allies would respond with strong economic measures.
But as important as geopolitics are, the continued fight over COVID remains the number one thing we all confront, with spikes in cases and fears of Omicron leading to shutdowns. As British Prime Minister Boris Johnson said his country was urging people to stay home.
From Monday, you should work from home if you can.
But there was also hope. Hope that vaccinations and boosters would offer us a better alternative to shutting down and staying home. And Johnson & Johnson CEO Alex Gorsky expressed confidence that science will help us get past the crisis in the new year.
Obviously, we're navigating our way through the pandemic, and there's likely to be twists and turns and ups and downs. That being said, I'm optimistic.
And in the end, despite some high inflation numbers, the markets decided to choose hope over anxiety this week, giving equities their best rally in 10 months and taking the S&P 500 to an all-time high, gaining over 3.8% on the week, with the Nasdaq just behind, posting 3.6% gains, while the yield curve steepened just a little bit, leaving the 10-year yield still below 1.5%. To explain what she makes of all this, we welcome now our contributor, Afsaneh Beschloss. She's the founder and CEO of Rock Creek. So, Afsaneh, we really need your advice here. What's going on? The market's really on a tear this week, by and large, after last week sort of selling off a bit, despite the inflation, despite the virus. Why?
David, great to be on with you today. And it's, again, about COVID, right? COVID news were really bad when we heard about Omicron, and COVID news this week as people got more data on Omicron, and not that it's not a problem, but seems to be milder, seems to be spreading, but not, not as scary as some variants could have been, I think has calmed the market. Plus, people are sort of moving on where there's more clarity on the Fed position on both taper and probably interest rate increases. But of course, we have the inflation scare at the same time coming up.
Well, and that was the question. How sure are we about the Fed? I mean, Jay Powell has made it clear they're going to advance, it appears, in the next meeting coming up, the tapering of the bond buying. But some people are saying he's going to go faster than even he thinks, and they may end up at a higher point. What do you think? And can he do that without really rocking the boat so much that it hurts the economy?
I agree that tapering will start sooner and go faster than was his original plan. And I think that it is overdue. But the important thing is that the Fed has really got two jobs, right? It's inflation and employment. And on the employment side, there is sort of a new twist that both, you may remember, Treasury Secretary Janet Yellen has been emphasizing, but so has Fed Chair Powell, which is equitable employment and more equity in growth. And I think that is where it may lead to slightly different actions, which might mean that while inflation, is about 6.8%, it might go up to close to 7% and peak around 7%. But my view is that it will come down to about half of that, towards the end of next year as these supply chains go away, but also as hopefully some of the Build Back Better actual actions get implemented and we start having some of these supply chain issues get resolved a little faster.
Afsaneh, you at Rock Creek are an investor rather than a trader, so you look over the longer term. You're not in and out of the market, as I understand it, constantly. At the same time, some people are saying now we should get used to higher inflation, not 6.8%, but significantly higher than we have on trend. If it's true, if we're set for 3% or even 4%, Larry Summers is now saying maybe 4%, what does that do to an investor? How does that change your portfolio?
So two things. One is depends on how this inflation gets translated. For example, a lot of people say, wages are going up and that's a bad thing. But really, in Economics 101, depends on exactly where the wage growth is happening. If the wage growth is happening at the lowest income levels, and that is actually the case, but don't forget, those wages are so very low that 20% increase is very little on a very small base, right? So if you have higher growth on wages, what you're going to have is potentially more ability to buy goods by that group, which has a higher consumption rate than higher income goods, and higher growth in the longer run. Now, the other side of this is, as I think some of these very short, I would call it shorter term, not just supply chain, but the fact that people were reading about inflation got them to buying more. The fact that we have some issues with specific issues because of COVID that happened with, for example, not, car companies selling their fleets or not investing last year. We're seeing that impact this year. As they invest next year, we're not going to have those same pressures. So, we might be closer to, my assumption is closer to 3.5%, but that will go down over time. So not so concerned about that.
So Afsaneh, let's take a global for a moment, because you really are a global investor. What are the differentiating positions among different countries? We see Europe with a slower inflation rate. China's in a very different place. Where are there really disparities that may be an opportunity for investors?
So really interestingly, in Japan, you saw very high inflation rates come out recently as well, in terms of their factory goods coming out of factories. We're experiencing higher inflation. The very interesting areas in Asia also are countries outside of China, Southeast Asia, India, but also some of the smaller countries in East Asia, because as all the geopolitical issues are going on, but also all the things that are going on in China, those other countries are beneficiaries in terms of both the higher growth rate and better control over COVID, but also the fact that they will benefit from diversification of imports into other countries. Europe, you're absolutely right. And we have seen at the ECB that the wording is changing a little bit more gradually than in the US. But we know also in Germany, the inflation fears are very strong historically. So I wouldn't be surprised if the language starts changing a little bit faster in Europe as well, in terms of their tapering, their version of tapering, and potentially starting to think about interest rates increases. Everyone is saying that will be a 2023 event. I wouldn't be surprised if it's a 2022 event. But let's also not forget, everyone is talking about this small 0.25% increases, which is what has been our experience since Fed Chair Volcker was in power.
Yeah, exactly. And you also have some potential fiscal stimulus in the form of some environmental investing that could be coming Europe's way. Exactly. Okay. Thank you so much. It's always a pleasure to have you with us. That's Afsaneh Beschloss. She is the founder and the CEO of Rock Creek. Coming up, we get a preview of what to expect in the new year from the chairman and CEO of Bank of America, Brian Moynihan. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. 2021 has been another wild year, with the continued fight against the pandemic, continued fiscal and monetary stimulus, and growing inflation concerns buffeting investors. But as we come to the end of the year, we asked Brian Moynihan of Bank of America to take a look at what he sees ahead in 2022. So, Brian, it's coming to the end of the year. Let's look forward to 2022 and what you could anticipate. First of all, let me ask you, how uncertain is it? Because right now, we're looking at the various banks and their projections. For example, on S&P 500, where it ends up, it's a wider range than we've seen in a long time. It's like 20%. Does that indicate there's less certainty about where we're headed in 2022?
I think if you look at the economic projections, they're closer bunched. Those have to do with multiple valuations coming in. Some of the, you've seen the IPOs trade down, and I think people are starting to say, okay, this can't keep going in one direction. So you're seeing people start to disperse, I think, around this question of where they think the market valuation is and whether the earnings growth can sustain. And if the earnings growth slows down, theoretically the market valuation ought to slow down first by just math and then by multiple contractions. So I think that's more the thing. But if you look on the economy side, we're at 4.2% for next year and 2.2 for the year after. And I think, that's a slowdown from this year, but the reality is it sort of has to slow down. I mean, and the Fed will raise rates to make sure it does because inflation and other things. So I think we feel very strongly what we see in our customer base is consistent with 4% plus growth, what we see on the commercial side and consumer side. Now, the risk to that is still this pandemic. And so the other thing you see is dispersion when you have this new variant surface and you see people taking different actions around the world and will shut down and will not. People start to make decisions based on that and in terms of their valuations and points. And the good news is because of the great healthcare systems we have and great science we have, the vaccine's out there, it's effective. It may have to be changed and played with, but you're seeing the impact less so far, knock on wood, and we'll see what happens. But that's a big uncertainty. That trumps every other thing you're talking about.
You're not an epidemiologist, as far as I know. I'm not,
yeah.
Goodness knows. But simply, you talk to a lot of experts. You have people that you talk to all the time. Your best guess, do you think by the end of 2022, we will have this largely behind us, the pandemic? Not to say it's all gone, but we won't have to deal with it day in and day out.
I think the risk is if the variant that the vaccines really don't work against. And so if you unwind the decision path by the people in charge of government and making rules, it's going to be, if my ICUs are overwhelmed, if my hospitals are overwhelmed, I have to slow down activity to keep people away from each other, to avoid that outcome, because you can't have people dying in a hall. That's just not fair. And so you remember back in the early pandemic, the field hospitals were being built. We needed 30,000 ventilators. We didn't use them all, but the good news is the treatments and the monoclonal antibodies and pills and all those things. So I can't make the medical prediction, but our experts say we've gone from that where it was just immediately had to get people away with all these tools, the treatment, vaccines, understanding disease better, the speed at which it can be adapted to where, so the waggle around an outcome's faster, right? So if you look, the market, there's a chart the other day, you saw, it took this long for the market to recover the first time, and it's gone in each time a new variants come up, and that's because of confidence that you can get behind it. I think that means you're in the endemic type of situation as opposed to the pandemic, which means we're going to be living with this, and there's going to be ebbs and flows, and I think that's what people are foreseeing 22 is about. Now, it'll take a little while to get used to that fact, and that'll be interesting to see how society adopts, but with what's going on in other countries, you're seeing them start to adjust because there's one fundamental difference is the vaccine levels are just not there. They are in the United States. So the judgment by a person here, given the same set of facts, could be different based on that fact alone.
Putting aside the pandemic and recognize that's a big thing to put aside, but taking that out of the equation for a second, when you take a look at the markets, typically valuations will be based on corporate earnings, and that should be a function of growth. You say growth looks pretty solid. Maybe it won't be as high as it was this year, but pretty solid. But there's another factor, which is also margins and profitability. How concerned are you going into 2022 about inflation and their ability to erode corporate margins?
So if you start at the end of the consumer, they have more money to spend, they're employed, and wages are growing fast. So their ability to absorb price increases, is there. Now, people don't like to give them price increases, and that's why companies have different strategies and different pricing schemes. But the reality is you'd be more afraid and I'm not sure, if the pressure came through on the supply side without the consumers in the condition they're in, I'd be more afraid of that question. And right now, companies tell us they're able to pass through price, either B2B or B2C. In other words, and shortages mean people buy no matter what. So, restaurant pricing, hotel pricing, trip pricing, people run specials and stuff, but it's all elevated, and that'll come through. So I think you have to start with the consumer being in great shape, having money, employed, and wages rising. And frankly, freed up to do more, and then you back into that. Think about all the cars that didn't get sold because of chip shortage. At some point, the chips are there, and those, that 16 million down to 12 or 13 million rate moves back up. And so I think that's just that. Housing, people are still buying homes. There's a shortage of homes, therefore there'll be demand there. Got to get prices back in control, frankly, there. But so I think, I'd be more afraid of the margin question for companies if you didn't have these. In the end of the day, it's a consumer drives the economy, 2/3 of the activity, whatever the right words are. If they didn't have the money to spend, and they do.
It looks right now, from what the Fed chair has said, that we're looking at 2022 as being a pivot year with respect to monetary support for the economy. How concerned are you about the rapidity with which they tighten that money supply? Because theoretically, we could do some damage.
Yeah, well, they have to slow down. You don't raise rates and expect the economy not to change outcome when you have inflation, and so that's the economics 101 about the thing. But let's back up to this Fed. You have same general people. 2019 economy X size today, X size. It's going to be bigger probably this quarter. Unemployment 3.6. We're at 4.2 already at the year end. We'll see where we are, but my guess is closer to that number. The consumer, all that fiscal stimulus went on. And so you think about all that and you're saying, wait a second, the wages have grown dramatically since then and I expect to grow at a faster rate. I think they have to bring the rates up. The pace will always be based on their view, but I think what's going to be more on people's minds goes back to the question of the pathway of the virus. Have we won the war, or have we won most of the war and the war's still out in front of us? And I hope and pray that the first is true, but I think that'll affect their pace more than anything else because they're always trying to make the judgment, because they're making the judgment based on the facts and it actually has impact in the future. But I think from a math, the employment, full employment, stable pricing, you could move rates up and relatively quickly. I think it'll just be slow because I think no matter what we think we know, we'll know other things about this virus every day, week, month, and I think that will keep changing their ebbs and flows. But they're going to be careful not to get ahead of it, but on the other hand, they have to be resolute to get the rate structure back. And the rate structure then was 2% Fed funds and 2% 10-year. You're saying, so what's different? Same size economy, same unemployment, more money in people's accounts, more spending, more final demand. At some point, you've got to bring the structure back.
So, as you suggest, the virus gets a vote, a really big vote. But assuming we stay on the same rough trajectory right now, 2% is what you're saying. When?
Oh, I think it takes a couple of years because I think they're going to be careful. I think next year, I think there's 3 increases in the market. Personally, I may believe that may be, people may, just like they have in the last few months, move a little forward, move a little higher, but I think it'll take a couple of years to get it back. And if you look at the dot plots, it'll be interesting to see where they come out of this meeting, but I think they'll move up faster, but I think it takes a couple of years. There's no, with the unpredictability it sits there's no great mileage in doing it too fast. They just have to be resolute and they have to signal the market it is coming into the market from interest rates for consumers and others is sanguine as it happens, and that's the key. If they have to do it fast, it's because it's gotten even more ahead of them than they wanted to.
So as you look forward to 2022, what's the biggest risk? What's the thing that worries you the most about next year?
I think you have the number one risk is a pandemic, because in the day, if we have to shut people and send people home, and like you said, we saw it in England, send workers home. They don't spend as much money on commuting. They don't spend as much money on coffee stands. They don't spend as much money in restaurants for lunch. All those types of things. So we've got to worry about that. The number two is, as the Fed goes in, the bubbles, are taken care of. That's part of their rules. As price stability means, prices that are untethered come back down. So I think that's where you got to watch out, is what is valued at such a level that will come down, that's interest rate sensitive, or is just sensitive to consumer demand changing around a bit and things like that. So I think that's the other area you have to watch. And some of the valuations are high, and Bank of America stock's always cheap. But other than that, you can have the market pundits give you different views. But the reality is that they have to slow down the economy a little bit. And then the other thing that's not a risk but a fact is that there won't be as much fiscal stimulus going to consumers from now to the end of next year as there was from last year to the end of this year. And that means they will start adjusting their purchasing based on that behavior naturally over time.
So as you say, Bank of America stock is always underpriced, right? It's always a bargain. But what will be done in 2022 to change that? I guess a different way of asking it is, what do you think the biggest change in your business, Bank of America's business, will be in 2022?
Well, our multiple is one of the highest in the industry, but it's still cheap to us.
I understand.
Because it's a great company. So what do we do? You'll see 22. normalizing the operations, getting people back at work, getting the systems configured. We'll spend $3.5 billion in technology. We'll add more bankers in the commercial lending business. We'll build out, another 100, 150 branches, or remodel another 200 or 300 more. The digital will just keep going. We had 2.6 billion digital interactions in the third quarter, just the third quarter. That'll grow. The competency of the digital will spread out even more and more stuff done digitally. Sometimes it sounds like we say the same thing every time I talk to you, but that's the reality of it. Is we're a big company. We can't make acquisitions because it's illegal. So we just sit there and say, how do we make this company better every day, and just kind of drive that. And so when there's one customer out there that's not being served by our company, I think they're being underserved.
Thanks to Brian Moynihan, Chairman and CEO of Bank of America. Coming up, we take a look at not the year, but the week ahead on Global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now to take a look at the week ahead on Global Wall Street. And we start with Juliet Sally in Sydney.
Thanks, David. It is a key week for the Chinese economy, which could reinforce the divergence between Fed and PBOC policy heading into 2022. The November data dump will offer the latest health check on the world's second largest economy, amid concerns the recovery is losing momentum. We're also on watch for the annual Central Economic Work Conference, which will set policy direction for the year ahead and possibly signal further easing after last week's reserve requirement ratio cut. Elsewhere in the region, it is a big week for central banks. Policy decisions from the Bank of Japan, as well as the Philippines, Indonesia and Taiwan. We'll also be eyeing jobs figures from South Korea and Australia, as well as India trade data. Now over to Danny Berger in London. Danny?
Thanks, Juliet. Well, in the region, it is a big week for central banks. So let's really focus on that, and not just a big week, but specifically a big Thursday for central bank decisions. It'll kick off in the morning with the SNB. That's, of course, the Swiss National Bank. And then we get Norges Bank following that. Then it's the Turkish central bank rate decision. That will be an interesting one, considering Erdogan has been pressuring the bank for aggressive rate cuts. Next, that will be followed by the two big ones. We have the BOE, that's at noon London time, and rate hike expectations were built in for this meeting. However, with new restrictions, new COVID cases in the UK, that's now been taken off the table. Most people expect them to hold. And then finally, just 45 minutes later, we have the ECB decision, where policymakers there have retained their dovish status. Now over to Romain Bostic in New York.
Thanks, Danny. The latest FOMC policy decision is on Wednesday. The meeting comes 2 weeks after Fed Chair Jerome Powell rattled investors when he suggested the central bank could accelerate its tapering of bond purchases amid inflationary pressures that were proving more persistent than thought. Now, sandwiched around the Fed meeting next week will be additional economic data on producer prices, retail sales, and housing starts. Housing has been one of the more resilient areas of the economy and one of the biggest contributors to the rise in inflation. Homebuilder Lennar has been both helped and hurt by the trend. The company is set to report fiscal fourth quarter earnings in the week ahead. Also look for earnings from Adobe, FedEx, and Darden, the owner of the Olive Garden restaurant chain. David?
Thanks to Juliet, Danny, and Romain. Coming up, we convene our roundtable together in the studio with contributors Larry Summers of Harvard and Steve Rattner of Willett Advisors. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. I am delighted to say that for the first time in nearly 2 years, we are back around our real roundtable in New York with our contributor Larry Summers of Harvard and also our contributor Steve Rattner of Willett Advisors, and they are responsible for investing the personal and philanthropic assets of Michael R. Bloomberg, our founder and majority shareholder. So, Larry, let's start with you. On Friday, we got CPI numbers. As predicted, they came in hot. Headline number 6.8%. You've been talking about this for some time. What are we learning about inflation that we didn't know before?
We're having it confirmed that it's not transitory. And I think everybody recognizes now, with the statements from Chairman Powell, with the statements from Secretary Yellen, that this isn't going to just go away of its own accord, that the Fed's going to have to take substantial action to control inflation unless there's some kind of other adverse development, a crack in markets or something of that kind. But we've put in motion for the first time in 40 years excessive inflation caused by overheating of the economy, and that's going to have to be worked out of the system, and that's probably not going to be such an easy thing.
Well, let's talk about that, how easy it is. Steve, do you agree with that analysis? And if so, what are the prospects that, in fact, the Fed can slow this thing down without really causing some damage to the economy?
Well, I completely agree with Larry, and I think you have to recognize it's a problem that was not created in 2 months. It was a problem created over the last 2 years, and so it's going to take multiple years, certainly, to work it out. I in no way want to predict that we're going back to where we were in the late 70s, but I was sitting in the Washington Bureau of the New York Times when Paul Volcker announced his new inflation policy, and I watched all that happen, and it took multiple years and a terrible recession to get it out of the system. So it is going to be painful, and it's going to be painful for growth, it's going to be painful for jobs, and we do have an election coming next year, which is going to be complicated.
So Larry, listening to the White House, they admit there's inflation. They still say it may be transitory, and one of the things they point to is gas prices. They said that's really artificially spiked it up, that's leveling off, maybe we don't have as big a problem. What about the difference between headline and so-called core?
Look, there surely are transitory elements in inflation, no question about it. But here's the thing, David. If you look at annual rates, if you take this month's number and you annualize it, it's 10%. So a lot of that is no doubt transitory. But to say that a lot of it is transitory is not to say that it's going to get anywhere near price stability on its own. And there's another point, which is we always talk about the things that are high and might be transitory. House prices on every index, rental prices on every index except the CPI are up 20% over the last year. The vast majority of that is not yet in the CPI, so it's probably coming. Every business person I talk to says the same thing. They say, we're going to have much higher labor costs going forward to retain our people. We're going to have higher input costs, and it's kind of okay because we're going to be able to pass it on. Well, that's an environment where there are pressures in many places for rising prices, not for falling prices. You know, one of the sectors that's been very benign over the last while is medical services. But as you see all the nurses who are quitting, there's going to be pressure there. As you see all the backlogs of elective procedures from the last year or two, there are going to be backlogs there. So I think we're going to entrench inflation way above 2%, perhaps in the 4% or even higher range, unless something happens to break the current mood, to break the current trend. And I don't think it's going to be 3 rate increases or 2 rate increases next year. I mean, remember this crucially. Monetary policy today is far looser than it was a year ago. Looser as measured by real interest rates, looser as measured by financial conditions, looser as measured by the size of the Federal Reserve's balance sheet. So we've got looser monetary policy even as job vacancies are way up and even as inflation is way up as well.
So, Steve, Larry says we should be having rate hikes. He's been talking about this for the better part of a year now. Do you think we should have more than 3 rate hikes next year?
Well, I don't know yet. We have, obviously, as Janet Yellen used to say, the Fed is data-driven, and you take each month or quarter at a time. But I agree with pretty much everything Larry said. But I would just make this point: like we talk about oil having leveled off. Right. There's no guarantee that oil is going to stay where it is. It's not a function of some specific supply disruption or something that's going to be easily corrected. It's largely a function of global demand, and global demand isn't going down at the moment. And so I think there is a lot of, not just in core, I think there's a lot of inflation that is really stuck in the economy. And yeah, I think Larry's right. If the Fed is really serious about getting back to an average of 2%, it is going to take a lot more than 3 rate hikes over some period of time.
But is the Fed going to have some assistance on the fiscal front? In this sense, Steve, we're not going to have the same level of fiscal stimulus, it looks like, going forward as we have in the past.
Well, we do have potentially more fiscal stimulus coming into the economy if they pass the Build Back Better plan, where the deficits are now and the paybacks are later, maybe. And so that would add 150 to 200 billion a year to the deficit. That's not a huge number in a $22 trillion economy, but it's actually more stimulus. And so I don't see, and you've also got, most importantly, what's really driving this, as Larry's colleague Jason Furman likes to point out, you've got over $2 trillion of dry powder on the sidelines, savings that people have above what would normally be expected. And that's what's coming back into the economy now, and that's what's really creating this. And that's still a lot of money left to come swirling around this economy.
So, Larry, let's talk about Build Back Better. In the past, you said as long as it's paid for, it's not really inflationary. At the same time, Steve's point, as I understand, is, well, you pay for it over 10 years. Over the first 5 years, you certainly are not paying for it. It's really running up deficits.
On balance, given the stakes involved, I would vote for Build Back Better very clearly because I think it pushes investments that our country needs. And I think that's the most important thing. That said, Build Back Better could be better. And one of the ways in which it could be better would be if the front-loaded fiscal stimulus was eliminated or scaled back. And frankly, the best way to do that would be to stop the relief for state and local tax deduction, which is targeted, goes largely to very wealthy people who probably don't need it. And if those provisions were changed, it would do a lot to reduce the upfront fiscal stimulus. There are other things that could be done as well. Why isn't carried interest addressed? There are a whole set of changes that should be made that aren't in Build Back Better that would make it more of a contribution to fairness and also make it more fiscally sound.
So we're obviously dealing in the world of the ideal, not necessarily what can be done. The SALT deduction is in there for a reason, which is it's the only way you could get enough votes in the House and Senate to pass it. The lobbyists behind carried interest have been unbelievably effective over a long period of time. So I agree with all of Larry's aspirations, and I would vote for it as well if nothing could be done about it. But I wouldn't call it a tragedy, but I would call it a significant disappointment to pass legislation like this that doesn't really address the revenue side properly in so many ways. We're not raising individual tax rates. We're not dealing with the estate tax problems. There's so much missing from it. That's really quite unfortunate.
But to come back to the core question of inflation right now, Larry, do you agree that over the short term, maybe not the longer term, the short term, the Build Back Better as written right now would be inflationary?
I think it would I think the inflation rate would be slightly higher in 2022 and 2023 with the Build Back Better than it would be without the Build Back Better. I think over the longer term, there might be some effects that go the other way. But I think over the next couple of years, what economists say, ceteris paribus, other things equal, it would raise the inflation rate, not by an amount. However, I think that is something that could easily be offset if it chooses to by the Federal Reserve as it pursues monetary policy.
Steve, as we talk about inflation, and obviously hindsight's 2020, but how did we all get it so wrong? With some exceptions, maybe. How did we get it so right? How did the Fed get it so wrong? Their projection's been really off. The White House, their projection's been really off. We don't usually get it that wrong, do we? Well,
first of all, we haven't had inflation in 30 or 40 years, so I think there's a question of how you really model the stuff and what goes on in the economy. I would say there was a bit of PTSD over 2008 and the feeling that we didn't do enough post-2008, certainly on the fiscal side, maybe on the monetary side. And so Chairman Powell also was up for reappointment. I don't want to be critical. I don't want to suggest nefarious motives, but he certainly was singing from the White House's hymn book in terms of a very dovish, lean-in kind of stance. And we just rushed to pour all this money out. Now, the piece that I would say I certainly missed, and I think Larry would probably agree, I don't think we anticipated the supply side problems. I think we got the demand side right, but I never imagined that you'd have this level of supply side problems due to everything from COVID in Malaysia, where semiconductors pass through, to workers not wanting to go back to work, to all the things that we were just talking about.
Yeah, a problem that certainly seems to be going away. And I must say, Larry, in the past on this program has said, he didn't fully anticipate the supply side of this, the supply chain problems. Okay, so that was terrific. Great start here. We're going to come back with Larry Summers and Steve Rattner just short time from now to address the really pressing problem of COVID-19 and now Omicron. And this is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. We are back with our real roundtable in New York with Larry Summers of Harvard and Steve Rattner of Willett Advisors. So, Steve, let me turn to you as an investor on behalf of Mike Bloomberg. One of the big stories, not just this week, but this year, is the COVID virus. Now we have the Omicron variant. None of us, I dare say, are epidemiologists. We can't know what's going on. And by the way, even if we were, I don't know that we could predict what's happening with the virus. But as an investor, what do you do about that? Because it could well affect your investments.
Of course, it has affected our investments, and I would say in several decades of investing, I've never been in a position where I had to analyze things like this that went way beyond the normal parameters you look at as an investor. And so it has introduced a level of volatility into the markets. It's introduced a level of inefficiency into the markets. You see stocks reacting in strange ways and not anticipating events the way the market is usually good at. And so it has made life very, very complicated.
And as an economist, Larry, one of the things that it may well affect is the supply chain problem that you just mentioned in the last segment.
I think one of the big questions about any time we're talking pandemic is the way I like to say it is, how does it affect the number of bartenders relative to the number of bar customers? Because the thing about the pandemic is that it affects both demand and supply. And so you know it's going to be bad for the level of output because there's going to be less demand and less supply. But with less demand and less supply, you don't know what it's going to mean for prices. And that's one of the puzzles in a lot of the discussion. Everybody said a year ago that, a year and a half ago, that we needed all kinds of stimulus because of the pandemic coming. Now, there are many people who say the Fed doesn't need to tighten because the pandemic is going to end and people are going to come back to work. Those can't both be, or unlikely to both be proper logical propositions. I think Omicron does introduce substantial uncertainty into the future, and probably even more for emerging markets than for the United States and Europe. It does certainly put an extra range of uncertainty. And I also think that we shouldn't be so callous as to analyze it entirely through the prism of markets or the prism of GDP statistics. Even if it doesn't have any effect on mobility and lockup policies and people are still flying planes, a much more pervasive virus is going to have a set of human consequences.
Well, it's a fair point. I know you'd agree with that, Steve. First and foremost, it's a matter of personal health and safety, but it does affect investments and does affect money as a practical matter. You have investments around the world, not just in the United States. Are you seeing a divergence among the markets according to actually the COVID? I mean, right now we see very different approaches. I mean, China really locks down pretty quickly to try to protect themselves. Europe, parts of it now are starting to really shut things down. Do you see a divergence in investment based on that?
Not really. You know, they are pursuing different strategies, but I'm not sure whether the COVID strategies are the biggest driver of economic differences. I mean, for example, China, there's an enormous amount going on in China. President Xi, we don't have time to talk about it today, but he's fundamentally changing the nature of China's approach to the market economy. That is far more important than the fact that China has its own approach to COVID versus how England approaches it or how Austria approaches it or this or that.
So, Larry, what about that, the approach of shutting down as opposed to vaccinating? Two very different courses have different economic effects.
Yeah, they do, certainly while you're locking down. I think what I have been struck by in general is that the policies seem to have more effect on the timing of the disease than they do on the overall level of the disease. That if you lock up, then you reduce the disease substantially for a while, but you have to unlock at some point, and then you get most of the cases that you avoided. If you look at the different countries within Europe, there are a lot of different strategies, but less difference in result. Part of what I think has to be a concern, when people talk about China, they always talk about Evergrande, and that is certainly a very big concern. But China, which has had nothing much happen that has increased its immunity levels, virtually none of the disease, vaccines that appear to not be nearly as strong as the ones we've used, how they're going to work their way out of their totally locked up situation, I think is a very big challenge. And the longer they stay locked up, the bigger that challenge is going to be.
No, they're going to have Olympics, which will open them up. And Steve?
Well, they're not going to open up for the Olympics. They're going to do the Olympics in a bubble.
Yeah.
And look, what I've heard about China and their vaccination strategy, nobody knows, of course. The speculation among people who know something is that between now and a year from now, when the next Party Congress occurs, they will figure out how to vaccinate people with vaccines that actually work, and they will then start to open up. Is that right? I have no idea. But let me just say two other quick things. One, I do think we're learning to live economically with the virus. I sense among my colleagues, among people I deal with, so far no one is flustered that much by Omicron. We're still in the office, people are still having meetings and so on, and it's something we're going to have to live with, like hijackings on airplanes. You just have another way to approach it. The second quick thing I'd say is I don't believe that the reason people are not working now is because of the virus, generally, obviously exceptions. I think the reason they're working right now, frankly, is many of them don't have to. They have strong balance sheets. They don't want to go back to an Amazon warehouse. I don't want to go to an Amazon warehouse. And so they're taking their time and figuring out what they want to do. And there are 11 million jobs open out there, and they know they can get one whenever they want one.
Yeah, really important point. Let's wrap this up now, looking forward to 2022, if we could. Larry, start with you. As you look forward to the new year, what do you think the biggest downside risk is that we face?
I think there are three risks: Omicron, inflation, and overextended markets are the three biggest risks we face, and I'm not sure in what order. And I'd also say the geopolitics of China, Russia, and Iran, all of which are potential sources of crisis in the next year, is an additional concern.
What about the full valuation, should I put that way, of the markets right now? What about that? What will correct that? Because they seem to have been almost impervious to all sorts of different slings and arrows.
Well, you know, if you look at the top stocks are down only a couple percent. The stocks outside of the largest caps are down 20% on average within the S&P. So I think you're getting to a more bifurcated market. I mean, Steve follows this much more closely than I. But when the idea comes that we're really going to see interest rate tightening, if I'm right that it's going to take more than 50 basis points or 75 basis points to get inflation under control, and that idea gets into the market psychology, if, as always has been the case before, Fed efforts to slow inflation lead to recession, I think all of those things are sources of risk for the market.
Give us 1 minute on testing. You identified Omicron as a big risk. Are we testing enough in this country?
No, we're fixing it now, but we're a year late to pervasive, cheap tests that you can give to guests to your home and get a result in 15 minutes. And the faster we move on that, and the stronger we move on that, and the more universally we move on that, the better it will be.
So, Steve, same question to you. Looking at 2022, biggest risk?
I agree with Larry's three risks, but I think the first one and the third one are linked. And I think when you get to the question of why are the markets so frothy, I think my own personal view is that the vast majority of the reason is the Fed. That when you take interest rates to zero, you know, it's TINA, what we call TINA. There is no alternative, and people come into the markets. And what you see happening right now is that every time there's talk of interest rates going up, the stocks that get hit hardest are the growth stocks, because their cash flows are so far out in the future that when you put a discount rate on it, the values go down as interest rates go up. And so I think the market is not really responding to international strategic issues. It might if they became more severe. I think the market's responding almost entirely to interest rates. And if the Fed starts down this path, I think it is going to be a tough ride for the market.
Well, that's my question, because start down the path. We've had it pretty clearly from Jay Powell. They're going to start down the path. The question of how fast and how far. So do you think, would you feel better if there was a bit more of a taper tantrum?
I'm not asking for a taper tantrum, and obviously part of why I think the Fed has moved so slowly is to avoid a taper tantrum. I think they've successfully mitigated the effects of stopping the asset purchases, the $120 billion a month. I think the market's accepted that. I'm not sure the market's ready for 3 interest rate increases next year, and I think that may come as a shock to them.
Yeah, I'm not sure the price is in. This has been a great roundtable, back again after almost 2 years. Many thanks to Larry Summers of Harvard and Steve Rattner of Willett Advisors. Coming up, the uncertain mix of sports and geopolitics. This is Wall Street Week on Bloomberg. Finally, one more thought. The geopolitics of sports, yet once again. This week, the United States made it official. It would not be sending any delegation to the Beijing Winter Olympics next year.
The Biden administration will not send any diplomatic or official representation to the Beijing 2022 Winter Olympics and Paralympic Games, given the PRC's ongoing genocide and crimes against humanity in Xinjiang and other human rights abuses.
The White House Press Secretary Jen Psaki said that the administration would be backing Team USA 100%, albeit from a pretty big distance. This is hardly the first time that we've seen the Olympics used as a lever in geopolitics, going all the way back to the 1980 Olympics in Moscow, when President Jimmy Carter didn't just keep American officials away, he kept U.S. athletes from competing after Russia invaded Afghanistan.
I can't say at this moment what other nations will not go to the Summer Olympics in Moscow. Ours will not go.
And the effect? Well, Russian troops stayed in Afghanistan for another 9 years. But what might hurt more than the loss of a few officials up in the stands at the games might be if corporate sponsors pulled out their support, something that Richard Haas of the Council on Foreign Relations has warned about.
In a world in which corporations, David, are far more vulnerable to political pressures from investors and others, I wouldn't be surprised if both governments and corporations essentially decided to hold back from China.
And then there's the threat that China just might not get to see some sports at all, as in the case of the World Tennis Association, which has pulled all of its matches from China out of concern over the fate of China's only #1 tennis player in history, Ms. Peng Shuai, after she accused a former senior government official of sexual assault, and then she disappeared. Longtime Olympics official Dick Pound explains.
All kinds of people were trying to get in touch with her to make sure that she was alive and healthy and not in captivity.
But if we really want to get China's attention, maybe we're better off using sports as a carrot instead of a stick. Just remember all the way back in 1971 what happened when a simple table tennis match paved the way for President Nixon to go to China. And the rest, as they say, is history. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.